Well, growing fears of an economic slowdown are spurring a sell-off in currencies as investors flee to the safe haven of the greenback. Asian currencies are not immune, with the Philippine peso leading the declines today. The Korean won also tumbling to a 13-year low, but they're not the only currencies that are under pressure. Now let's take a look at 8 key Asian currencies, and they've all fallen this year against the dollar. Now, the yen is the worst performer. In fact, it's slumped nearly 18% as the Bank of Japan sticks to its ultra-loose monetary policy. The U.S. Federal Reserve, on the other hand, is ratcheting up borrowing costs to battle a 41-year high inflation. Now, the won, the peso, the baht, all rounding up the 4 biggest decliners. And here are the remaining 4 currencies that have dropped between 4 and about 7%. In ascending order, it is the Indian rupee, the Australian dollar, the Indonesian rupiah, as well as the Singapore dollar. Now, Gareth Leder, senior economist at Capital Economics, joins us now. Gareth, with the plunge in Asian currencies, how would it affect these countries' debt?
Well, the important point to bear in mind, first of all, is that these currencies are falling not because necessarily they're weak per se, it's because they're facing a very strong dollar. And so with the exception of the Japanese yen, which has fallen by nearly 20%, most of them have been in the range of 5 to 10%. I think for most countries, central banks and policymakers, I think they're relatively comfortable with that. There's 2 reasons why central banks typically worry about falling currencies. The first is a high level of foreign currency debt. And the second is inflation. Certainly on the first point of foreign currency debt, that with the exception really of Indonesia, it's now pretty low in Asia. So you don't get these big currency mismatches when currencies fall. I think the second worry is inflation, that higher imported costs can push up inflation, which is obviously a big and rising concern in Asia right now. And I think that's why central banks are a little bit worried. They're not panicking, but they're concerned.
Well, Gareth, the prices of cooking oil and grains have fallen to pre-Ukraine war levels now, but could that be countered by weaker currencies in APAC?
Well, I think falling commodity prices, especially oil and grains, I think is reason to be hopeful that a lot of the reason why inflation has risen across Asia in recent months has been this pickup in global commodity prices. Core inflation, so that measures inflation excluding food and fuel, has also risen, but not by as much. So if we do see commodities dropping back, then hopefully we'll see headline inflation rates peak quite soon and then probably fall quite sharply by the end of the year. And hopefully by early 2023, they'll be back to within central bank target range. And that means that central banks across Asia, while they're likely to hike interest rates over the coming months, tightening cycles are unlikely to be anywhere near as aggressive as we've seen in the rest of the world. And hopefully by the end of this year, maybe early 2023, then tightening cycles may even come to an end as well.
So now then, which countries in APAC will suffer most from those weakening currencies, and which do you think will benefit?
I think countries will benefit from a weaker exchange rate because of the boost to their exports. And that's quite important right now that, over the pandemic, Asian exports have performed very well, as you've seen consumers in the West switch from going on holidays to the cinema and so on, back to spending goods on Amazon. Now you've seen a kind of switch back in consumption patterns now. That's going to hit Asian countries hard. So if you do see weaker currencies, and I think Asian exporters will benefit. I think the flip side, though, is that consumers will be hit harder by higher import costs. And so you'll get a slowdown in consumption that way. So the two will probably cancel each other out, I suspect.
And now, Gareth, before we go, markets are betting on a 50% chance that the U.S. economy will head for a recession. In fact, Q1 GDP already shrank about 1.6%. So how long do you think the greenback strength will continue for?
I think it will last for a while because the big worry for the Fed at the moment isn't so much weaker growth, it's high and rising inflation. So I suspect that you'll see some further or quite aggressive interest rate hikes by the Fed over the coming months, certainly much more aggressive than we're expecting in Asia. And that means that the US dollar will probably continue to climb higher, including against Asian currencies. But maybe sometime around the middle or so of next year, when the Fed's tightening cycle is over, you could start to see some of the downward pressure on Asian currencies ease. So in the near term, I think further weakness, but kind of, second half of next year, I think Asian currencies might start to regain some of that lost ground.
Many thanks for speaking with us there, Gareth Leather. He is with Capital Economics.